Welcome, everyone. Thank you for joining us for the webcast, Pay Equity Legislation, What You Need to Know About the Latest Legal Developments, sponsored by ePay Systems. Before we begin, I would like to remind you that this webcast has been pre-approved for IHR certification credits, 1 HRCI webcast for certification credit, HRCI e-learning credit, and SHRM credits. Please be sure to attend the complete webcast to receive your credits. You will receive an email from HR.com within 1 to 2 business days, which will include the certification credit information. Questions may be submitted anytime during the webcast by typing the question in the Ask a Question text field and clicking Submit, the orange button located on your screen. And I will now turn it over to Michelle Lanter-Smith.
Hello. And again, welcome to our webinar today, Pay Equity Legislation. My name is Michelle Lanter-Smith, and I'm the Chief Marketing Officer here at ePay Systems. And I'd like to extend a warm welcome to all of you on the line with us today. Thank you for sharing some of your time with us. I know you're very busy, and we appreciate it. And we think we have a jam-packed hour here to be able to share a lot of really good information on this very interesting topic that probably keeps a lot of us up at night. Today, we have with us our featured speaker, Christine Hendrickson from Seyfarth. Welcome, Christine.
Thank you so much for having me, Michelle.
Let me tell everyone on the phone today a little bit about your bio. You're obviously very involved in this topic. Christine is a senior council member at the Chicago office of Seyfarth, where she is a member of the firm's Labor and Employment OFCCP Compliance, Affirmative Action, and Diversity team. Christine works with clients to revamp their personnel practices and build best practices and ensure compliance with mandates impacting recruitment, hiring, promotion, compensation, performance evaluation, discipline, and termination. In addition, Christine provides strategic advice and counseling to employers on diversity programs, reduction in force, pay equity, and employment compliance diagnostics. She also represents employers in a range of litigation matters challenging pay, promotion, hiring, and other personnel decisions. So welcome, Christine. It's great to have you. Let me just go through on the next slide, if I may, what our agenda looks like. So it is going to be jam-packed. She has a lot of information to share with you, and we've already told you about how you can really ask questions. Just type them into the question box, and we'll be monitoring those for Christine and getting those questions over to her. So she'll try to work your answers throughout. But what we're going to do first is she's going to talk about the landscape, what really is happening right now, an overview of some of the state law changes, and then, of course, an overview of the new employer information report and some of the changes that are coming there and what you'll need to do and how to get that out. Throughout, though, we've really kind of looked at what people commonly ask in this area, and so you'll see that our presentation is framed around questions that are probably top of mind that you're thinking about, and she's going to give the answers to those and how typically what is the best practice and how to go about things. And then what she's going to do is she's going to talk about, well, where do you go from here? So how do you mitigate legal risk, and how do you do different types of analysis on pay, and how's the best way to go forward? So let me just tell you a little bit about ePay. On the next slide, you can see that ePay Systems has been a successful leader in the human capital management technology space since 2001. We're a Chicago-based firm, and we've always been about developing SaaS-based solutions for the employer with a hard-to-manage hourly workforce. Now, not only are employees hourly, they're probably usually distributed. They might be going from customer to customer, job site to job site, mobile, whatever. Sometimes some groups may be centralized, some may be very distributive. Our specialty is in this area of really having an hourly workforce where you might have a different type of mix of hourly people. And that makes it very hard to track, hard to manage, and how to get control of your costs. But these are the type of customers that we love to serve and really have been our family of customers forever. Since our inception, our priorities have always centered around doing things smarter, making our services affordable, and going the extra mile for our customers. That's why we have some of the most largest building service contractors, staffing firms, venue managers, some of the folks that you see on the screen right here today, as companies that we call valued partners. So what makes us different? Well, we are in over 75,000 work sites across North America. We provide a full, complete, unified human capital management solution from pre-hire, so all your applicant tracking and recruiting, through HR, payroll, time and labor, and performance management. But truly at the heart of our system and our legacy is our workforce management technology. We have a unique, flexible, cloud-based system that really helps you get a hold of your costs, makes things visible, what's happening out at the sites. Are people in? Are they out? Are they on the floor? Are they not? Are customers being served according to your SLA agreements? And so we believe with a strong workforce management system, you now can truly elevate the full ROI of your human capital management system and get the efficiencies and the streamlined processes that you need across from the whole employee life cycle. Now, how do we do this? Again, we believe strongly in our customers. We're very proud of our 99% customer retention rate, and one of the reasons we do that is because how we support our clients. All clients of ePace get premium customer support 24 hours a day, 7 days a week. But that's enough about us. I'll be back at the very end. I'd like to turn it over to Christine and let us get started on our presentation on pay equity. Christine?
Great. Well, thank you all so much for being here. This is such a fantastic and timely topic, and it's pretty much where my phone is ringing off the hook right now is conversations about how do we handle pay equity and what do we look like. Because I'm a lawyer, I have to start with a legal disclaimer that this is not legal advice, and of course that if you have specific questions, you should consult with a lawyer, and I'm happy to answer any questions that are more general, but of course it's not legal advice. So what are we seeing in 2016? What we're seeing in 2016 are three major changes to the pay equity landscape. The first one is the one that seems to be getting the most press, which is the EEOC's proposed EE0-1 report. So we're going to get into what the specifics and ins and outs of it, but it's a report that will be required of all larger employers to begin filing compensation information with the EEOC beginning in March of 2018. We also see a major increase in regulatory enforcement. So the EEOC, and especially for federal contractors, the OFCCP, if you've gone through an audit with either of these or a investigation with the EEOC or an audit with the OFCCP, it will not be news to you at all that there's been a major increase in regulatory enforcement. And then the third big change are the state law changes. So in our time together today, we wanted to just talk through kind of what changes we're seeing to the law, and then really much more importantly, answer some of the big questions that we're often asked at Seyfarth, and also answer questions that you may have. So I do encourage you to answer questions as we go through. Okay, so let's begin with talking about the EE0-1 report. As I mentioned, on February 16th, the EEOC issued proposed regulations. There has actually been an update even since these slides were originally created, which is the federal agency that proposed these, the EEOC, actually submitted revised guidelines that change things ever so slightly. And so now, instead of an effective date of September 2017, we're now looking at an effective date of March 31st, 2018. What is required? Employers are required to report W-2 wages to the EEOC. This is still in process of having some modification, and where we are in the process. Let me actually take a step back and just give you a sense of where we are. So the EEOC proposed the rules those went through a hearing process within the EEOC. They made some minor modifications, and those modifications basically fall in two different buckets. The first one is that change of date, where the first report would be due March 31st of 2018, and that report will require that all employers with more than 100 employees submit their both the hours worked and then the W-2 wages for all of their employees. What do we mean by their W-2 wages? What we're talking here is their gross income. So it's salary, fees, bonuses, commissions, taxable fringe benefits, tuition, and other forms of reportable earnings. Now, the EEOC has been very specific now that what they mean by this is the box one of your W-2 earnings. Box one of the W-2 earnings, and the deck that is going to be sent around also will have these modifications in there that shows that we're talking only about box one here. Box one has all of the fee, the hourly rate, minus things like your contributions to your 401k and the like. It's going to be based on this deck, it says based on earnings for a 12-month period between July and September. Now, this is what's changed with the new reporting guidelines, with the modifications that are going forward to the OMB now. Now the EEOC is saying that it needs to be based on the end of year contributions. So this is a great thing. On these slides, we're talking about kind of the earlier version. The new revised version that the EEOC put forth actually changes this slightly so that now employers can report based on their year-end W-2 earnings, and so this is going to be a slightly beneficial approach for employers. So what happens? How do we fill out this new EEO-1 report? Okay, so you have the same EEO-1 categories that you have right now for the EEO-1 report. So you have, starts with your executive and senior level officials and managers, and then your first and mid-level managers on down to the professionals and operatives and craft workers, the exact same categories that we have in the EEO-1 report now. What is different, however, is that in the old EEO-1 report, you remember that you fill out basically the number of people that are the number of men, the number of women, and the number of men and women within each race ethnicity category. So the number of African American men and then the number of Asian females, for example. The same approach applies with this new pay report. But instead of providing just counts or demographic information, in addition to providing that, so you're still going to need to provide that demographic information, but the big change is that you're also going to have to report their earnings. So here we see that we have the pay bands that are reported. So you're going to basically say, let's take the first column right here with the Hispanic Latino employees. You would report the number of male Hispanic Latino employees and the number of female Hispanic Latino employees whose W-2 earnings, again, remember that the final slides that you're going to receive are going to have the updates that the EEOC has. So it's the end of year earnings as of next year with a first report in March of 2018. So the W-2 earnings at the end of next year that falls into each of these categories. So you would say that we have one Hispanic Latino employee that is a male that makes under $19,239. and then you would have, you would report into each of these categories. Now this example here is for your executive and senior level officials and managers. So you probably will have more folks at the bottom of this report in the, above $100,000 range often. But the categories, so the 19,239, 19,240 to 24,439, they will apply to every single EE0-1 category. So bottom line, you report W-2 earnings as of the end of the year with a report filing in at the end of March, categorizing the number of people by W-2 box 1 earnings in each of these categories. In addition, you also have to report the number of hours that are worked by each of the employees that are working in each of these categories. So for example, you would say for the African American female who is making in the 101,920 range, the number of hours that that employee worked. As the example that we're giving is the executive and senior level officials and managers. One question that we often get is, what about exempt employees? And we're going to get into that a little bit more because, of course, for the employees that are exempt from overtime, you're often not tracking that information so that you don't have that information, those hours readily available. And so we'll talk a little bit about what the EEOC's current solution is to that. Okay, second big change, changes to the regulatory enforcement. For the OFCCP, which is for federal contractors, an agency that you know all too well, but for the non-federal contractor employers that were here, the OFCCP is the Office of Federal Contract Compliance Programs, and it is a division within the Department of Labor that tracks that regulates the affirmative action obligations that federal contractors have, federal contractors and subcontractors have. So the OFCCP has new sex discrimination guidelines that came out, and those new sex discrimination guidelines don't go quite as far as we thought that they might in terms of pay equity, but certainly are very focused on the agency's interest in continuing what has been their #1 priority for the last couple of years, which is compensation discrimination. This has all come with Directive 307. So for many of you that are federal contractors, you may remember that the that there was an approach that the OFCCP took, which was to have a focus on basically very granular looking at job title by job title and looking at differences of greater than 2% or $2,000. And where we saw those differences of greater than 2% or $2,000, the OFCCP would ask more questions. However, in 2014 with Directive 307, the OFCCP blew up their approach since 2006, and with a very new approach. So Directive 307, and I'm actually right now at the NILG conference, and Pat Chu, who's the director of the OFCCP, just spoke to us yesterday. And Pat Chu, the director of the OFCCP, Director Chu indicated that one of the goals of Directive 307 was, to use her words, unshackle the agency and give them the ability to not look just at these very narrow differences, but look at compensation from a much more holistic approach. We're seeing the focus in OFCCP audits. Everything seems to be about compensation. Now, in terms of where their monetary fines are, hiring is still their #1 area where they're finding monetary fines, but where we're finding the time that is spent in an OFCCP audit, it's very clear that the OFCCP is looking to make sure that there is a significant drive and focus on where we are in compensation. The EEOC is also not sitting idle on compensation. The EEOC also beginning in 2014 had an approach to actually do directive investigations. So where you have even in the absence of an actual charge of discrimination, able to look into and evaluate employers on compensation-related differences. So that's the other big change. The last change, and again, this is an area that is just constantly changing, is major changes to the legal landscape, especially with state laws. So this chart shows you kind of where we are or where we were as of about a week ago, but there has been even more changes just now 2 days ago in Massachusetts, and we'll talk about that. Okay, so this is what there has been under the federal law. There have been laws since the 60s on the book prohibiting pay discrimination based on not only sex or gender, but also on things like race, ethnicity, and religion and national origin. Both under the Federal Equal Pay Act and Title VII, and for federal contractors, Executive Order 11246, prohibit discrimination on those bases. However, those laws have been somewhat limited. So under the Federal Equal Pay Act, you had to be doing equal work, and you had to be working under similar working conditions. So you're really comparing potentially not only job titles, but only maybe a slight deviation from job title, and often the default was to job title. Under the Federal Equal Pay Act, you also had to be sitting in the exact same location. So if you were working in an office in Charlotte, you couldn't be compared to someone who was working in Raleigh-Durham even, much less someone that was working in New York or in California or in any other state. Under Title VII, you didn't have to be in the exact same title, but you had to be similarly situated. And that definition of being similarly situated really meant that you were talking about people who were reporting, who had similar reporting structures, who were doing similar work. It was a much narrower category. So what happened was California was first, moved forward, kind of first and farthest on this. California and New York moved together very, very, very quick in time. And both of those laws, the California Fair Pay Act went into effect on January 1st, and then the New York Pay Act just slightly thereafter. And the California Fair Pay Act, you'll see in this comparison group section, you don't have to be doing equal work. So we're not looking at people that are doing the same job. We're looking at people doing substantially similar jobs. And I know that this seems like legal minutia, but it really matters, because what it means is that you have people that you could have someone who, for example, there's then a drive, at least in some of the literature now, there's not been cases out yet that would suggest that you can make these kind of comparisons, but at least the plaintiffs' bar are saying things like, well, if you have someone who is a janitor and someone who's a housekeeper, those positions, because their essential job duties are relatively similar, their pay should be similar. And that is a pretty radical move and change in terms of how we're looking at pay. So again, what matters is the similarity in terms of who is being compared to one another. The New York law, as you'll see, tracks the federal Equal Pay Act, so it's equal work and similar working conditions. However, in New York, and this is also true in California, it's true to a lesser extent in Maryland and Massachusetts, that you don't have to be sitting in the exact same geographic location. In California, there's actually no limitation at all. You could have someone who is a California-based employee and say that they should be compared to someone in New York. Although we'll talk about, what do we do about geographic differentials as we go through. In New York, you have to be sitting in the same geographic region, which is no larger than a county. So there are some changes in basically who can be compared in terms of what the work is, and then who can be compared in terms of where they're working. The other difference between these new changes to state law and what we're seeing, at least with Title VII, is that you have to explain the entire difference in wages. So let's imagine that you have two employees and they're only $500 different in pay. So someone makes $24,500 and the other person makes $24,000 even. Under the Federal Equal Pay Act and also under these state laws, California, New York, Massachusetts, etc., Maryland, you are required to explain that entire wage differential. So those are some very big changes that we're seeing in state law. Okay, so what we thought that might be helpful is to answer some of the questions that were most frequently asked, and then I'm so grateful we have many people who have asked great questions, and so we are going to take some of those questions as well that are coming in on the system. So feel free to submit questions there as well. Okay. So one of the questions that I'm often asked is, my company is headquartered in Illinois or in North Carolina or in Nevada or wherever, and it's not one of those states that we specifically called out as having changes. Why should we care about the developments in the other states? The answer is, first, the EE0-1 modifications and the regulatory changes that we're seeing in other locations are broadly applicable. So the EE0-1 report will be required of all employers with more than 100 employees. So it's not limited to any, it's very broad, and many employers will be required. You may know that if you're a federal contractor, you're required to file the EE0-1 report if you have more than 50 employees. However, you'll still be required to file the demographic portion of the EE0-1 report, but you will not be required to file the pay portion if you're a federal contractor with between 50 and 100 employees, or 50 and 99 employees. Only employers with more than 100 employees are required to file the pay report. The state law changes also impact companies with employees in different states. That's another reason. So we will often find that you will have a company that's headquartered in Illinois or headquartered in a state that doesn't have a new equal pay report law on the books, but they will have sales employees or other employees that are based in those states. And so you will be subject to those laws if you have employees that are working in those states, at least for the employees that are working there. We're also seeing just a big trend towards broader pay equity statutes in the state. We often see a push to have broader laws also at the federal level. We are not seeing a lot of traction, perhaps not surprisingly, in the current environment, although who knows what will happen after the election. but the broader pay equity statutes within the states is certainly a trend. So as I mentioned, Massachusetts just signed their law this week, and the final slides that will be sent out to the team will also include the modifications from the final Massachusetts, for the final Massachusetts law. Okay, so one of the questions that I often get is, what should I do? We've got state law changes, we have the regulatory environment, we have the EE0-1. What should an employer do, or what should you do after leaving our session today? The best and most significant way that you can reduce legal risk in this area is to conduct a proactive pay equity analysis and make adjustments to pay where it's possible, or where it's required or necessary by what you're seeing with the results. It is, I would say, a pay equity audit, though, is not for the faint of heart. It's not as much of a undertaking from the HR community as you would perhaps imagine, but it does involve making sure that you have the budget not only to just to conduct the pay equity analysis, but also you'll want to make sure that you have a budget to make any adjustments that would be needed from the results of that. So what it usually involves is partnering with your compensation team, HR, legal, and when we conduct a pay equity analysis, we usually partner with an outside labor economist. We gather readily available information that impacts pay, things like how long someone's been in their role, how long someone's been with the organization, using their age as a proxy for their prior experience. We look at how long they've been in the workforce kind of generally, and then it would be looking at things like their grade or their level in the organization, their function, etc. So when we conduct these multiple regression analyses, I can't strongly encourage you enough to ensure that you're partnering with your legal team or outside counsel so that you don't end up in that position where no good deed goes unpunished, and the proactive steps that you're taking to ensure that you are addressing any differences in pay are not used against your employer in the event of any litigation. So the first step is you gather a small team, and again, this is not an all hands on deck exercise. This is going to be a fairly limited number of core team members that would do that would be involved in the analysis. You would look at, how do we pay employees within our organization? How do we group employees within our own organization? And then using that data, you would run a statistical analysis for large groups or a cohort analysis for small groups and evaluate reasons for any outliers. Understanding that there are differences in race or gender is certainly something that I would recommend looking at. And then once you do that, you'll see if there are individuals that need an adjustment, and you can implement those in different approaches. One thing that I would caution against is that often once you do the initial analysis, you will find that there are a lot of groups that are flagging, but there are often very good reasons why people are paid different amounts. So it could be things like you have an IT group, and in the IT group, the factors that you're initially looking at are not explaining all of the differences in compensation. However, once you start adding in the certifications that those IT professionals have, it can be those differences can completely disappear. So before you make any adjustments, I would really encourage you to make sure that you're evaluating the model and ensuring that includes everything that it needs to have. So again, these are the major milestones that you would take. You'd identify the risk. You would have your initial contact with outside counsel. You'd have a kickoff call where you would discuss, how do we group employees within our organization? So are we looking function by function? Do we have grades? Do we have levels? how do we find employees that are similar to one another or substantially similar to one another? Then you would conduct the preliminary analysis, you would interpret the results and explore different models. Look to see if you have to have any remediation. Often that remediation is not that you have to make pay adjustments, but you find people are actually in the wrong job title or their grade is inaccurate in the system. So just making those changes is something that would be really useful as you go through that process. Making any policy and practice changes. And then this is not a one and done deal. Unfortunately, in our new environment with the pay equity, a pay equity audit is something that should be done, at least on a biannual basis, because compensation is pretty fragile. So that you can imagine that you have a scenario where everything looks really good for that moment in time, but then as you are making promotions or you're making external hiring decisions, it undoes the adjustments that you've already made. So ensuring that you're doing routine follow-up is really important. Okay, so the next question that I often get is, how do we begin to group employees? And this is the meat and the heart of any pay equity audit. The first thing is that there are going to be, differences in state and federal law, as we mentioned. So under federal law, and in New York, under the Federal Equal Pay Act at least, you're looking for equal work that involves the same skill, effort, and responsibility, which is performed under similar working conditions. In California, it's going to be this broader grouping. So the purpose, when you are beginning a pay equity exercise, I encourage you to look at, what is your end game? How do you want to ensure that the end goals are matching where you are? So if you're looking at it from a proactive pay equity analysis, you're often not looking job title by job title, but are looking at broader groupings of employees, more similar to where they are going in California. If you're doing it, if you're not sitting in California or in Massachusetts, which has actually a very similar broad approach that California has, you'll likely be looking at employees, potentially looking even down to the job title level. So again, the goal of the pay equity analysis is going to be set by your internal team, and there are many different approaches. I personally think that it's important to group employees in ways that match your pay system. That's going to be the most critical, is that there's no one-size-fits-all approach. Every employer is going to group employees differently because every employer pays their employees differently. So ensuring that your pay equity analysis matches both the policy within your organization and the practice within your organization is going to be really critical. But it is important to look at differences, state law differences. So when we're talking about jobs and working conditions, what do we mean about this? So jobs are people that have similar skills, either equal under federal law and under New York law, or substantially similar skills, effort, and responsibility. So skills are things like your experience, your education, what do you need to do in order to do your job? Effort is physical or mental exertion, and then responsibility is how much accountability. So that could be things like, are you an individual contributor? Do you have management responsibilities? What's the scope of your management responsibilities? And working conditions has to do with your physical surroundings and also any hazards. So the working conditions seems like it's set almost for a different time in America's employment history, where you were looking at things like how cold is it there, and certainly for folks who have a manufacturing part of your workforce, this is going to seem very similar. But if you have a more professional workforce, it's difficult to make differences in terms of physical surroundings or access to hazards, because often everyone is sitting in the same building and their physical surroundings and access to hazards are different. I would believe that if we came back together 2 years from now, we would find that there's going to be a lot of modification of or expansion of what we considered working conditions, because just the physical surroundings and hazard seems to be a pretty narrow focus from what we're seeing kind of more broadly. So the bottom line is, look at your own workforce. There's no one size fits all. Every employer is going to be a little bit different. Here are some of the factors that you may want to look at: lines of business, job functions or job families, grades or level, wage and hour classification, your bonus eligibility, where you're physically located, your geography, and then also the skills, effort, responsibility, and working conditions. And only when you look at those things as a bundle can you find analysis groups that match your organization. So there is no, as a bottom line, there is no one approach or one way to group employees. It has to match how employees are paid within your own organizations. Okay, so the next question is, do we need to be just concerned about base salary, or what about things like bonuses or LTI, or getting more granular? What about shift differentials or overtime, or even fringe benefits? The W-2 wage, for the EEO-1, we're talking about your W-2 wages. So that is not going to be just your base salary, but is going to be a lot broader, to also include things like those that we've already discussed. In California, it also includes not just base salary, but other forms of commission, compensation like bonuses and commissions. And in New York, there's an argument that it's actually a slightly more narrow approach. So the state law, the law differences matter. One recommendation that I would have as kind of a takeaway would be, when you're conducting a proactive analysis, I'd really discourage you from doing a total pay analysis, but rather look at each of the individual components of pay. And the reason is that when you're doing a statistical analysis, a regression analysis, you are looking at what are the factors that are relevant to someone's compensation. So when you look at base pay, it may be things like experience, how long someone's been in their role. It may be related to specific certifications or geographic differentials, those types of things. When you're looking at bonus or LTI or overtime, there's going to be different things that matter. So for overtime, one of the major things that's going to matter is, are you an employee who's eligible for overtime? And if you are eligible for overtime, do you want to work? Is it a voluntary? Is it something voluntary, and are you willing to volunteer for that overtime? So controlling for someone's certification is really totally irrelevant to their overtime wages. Similarly, when you're looking at bonuses or LTI, often the things that matter are that year's performance rating and then the success of the company, kind of the individual contributor portion of it, and then the company performance portion of it. And so again, things like certifications, except for insofar as they are, reflected in one's performance, are not going to be relevant. Likewise, company performance may not be as relevant to the base salary analysis, but would be totally relevant to a bonus analysis. So my one tip would be to look at everything, but make sure that you're looking at them separately. Okay, and this is the New York law that I mentioned that's a little bit narrower. Okay, another question that we get a lot is, but geography matters. Are we not allowed to take into account differences in the market anymore? I had mentioned in California that you could be compared if you were a California employee to an employee working in Omaha or in Sioux Falls, or in New York City. And often there are very significant differences in market, and different people are paid differently. So while geography or the location where you're working matters, in Maryland you have to be in the same county, in New York you have to be no larger than the same county, under the Federal Equal Pay Act you have to be in the same establishment. Geographic differentials may still and are likely to still be okay. In California, they specifically, the Senator Jackson, who was the senator who actually initiated and implemented or introduced the California Fair Pay Act, specifically wrote a letter to the California Senate Daily Journal, said that work that is performed at different locations, we're not intending to say that can't matter. It just has to be one of the factors that you're considering in reasons that you have differences in pay. So, for example, you may not be able to say that there's a difference between two locations that have similar cost of living. That may not be a good reason to say that there's a geographic differential. But if someone is sitting in San Francisco, certainly a higher cost of living market than Omaha, and your organization can take those things into account. But whether or not it would be also appropriate to say that there are differences in Kansas City and Omaha would be a fact-specific inquiry to determine, really are those markets so different that it makes sense to take it into account. But geographic differentials are still something that you may look at. The next question that we often get is, what are the factors that we may use to legitimately explain pay? This shows you what we're seeing in California. They specifically say a seniority system, a merit system, the quality, quantity of production, or this general catch-all, a bona fide factor other than sex. These are some of the things that you could certainly use to explain pay, but they're not exclusive. So there can be many things like the geographic differential that fit into this other factor other than sex that are going to be very specific. And again, I recommend that we look at the state that you're talking about. So in Massachusetts, they actually have a different set of requirements of what are the factors that influence pay. So it's going to be a little bit state specific. Another question that we get is, what about prior salary? Often I hear from employers that, when one of the main drivers for why someone is placed where they are in terms of their salary is where they were coming in. So someone comes in was making $50,000 in their previous position, you make them an offer of $58,000 or $55,000 so that they're getting some premium or inducement to join your organization. So if someone was making $45,000, you may make them an offer to come in at 52 or 50. And the question is this still permitted? And the answer is, it depends. In Massachusetts, the new law actually, a brand new law actually specifically says that you cannot ask about prior salary. And in California, although there was a proposal to have the same, it has not passed yet. So it's going to be state law specific in terms of whether or not you can take into account prior salary. I would want to mention that starting salary is typically the most important pay decision, and there is this start low, stay low phenomenon. So that if you start low, it's difficult to kind of catch up as you're getting 3% increases year over year. That difference actually tends to grow over time. I recommend considering a formal policy regarding how the employee how your company is looking at and setting starting salary. Okay, what about pay adjustments? What are the main considerations when we're doing pay adjustments? There are a lot of things, and we actually at Seyfarth are doing a full presentation just on how do you do remediation, because it can be, at this conference that I'm at right now, we did there was a 2-hour presentation that we did that was just looking at how do you do remediation. But this is the key, is you want to look at how you want to do it. Are you going to do it as a standalone? What's your budget for that? Do you have a standalone budget? Are you going to need to carve that off from your merit budget? who are you going to adjust? Only groups that are statistically significant? What about if men are paid less? Do you make adjustments there? What about if their group it looks okay, but they themselves are an outlier? Are you going to make an adjustment there? And then there's all different ways that you can calculate these adjustments. So peanut butter would be, everyone gets the same adjustment amount. You could do a targeted or laser beam adjustment where you're giving only specific adjustment amounts to some employees, or a more hybrid approach. There can also be, caps. You could say, we're not going to make an adjustment of more than 10% to certain employees. And then there's a big conversation that happens when we're talking about pay equity analysis is, what's the timing? Are you going to make any adjustments that need to be made at the same time that you're making merit increase decisions? Are you going to do off-cycle adjustments? All employers right now have this really beneficial timing where you have the new changes to the FLSA overtime rules that are going into effect at the end of the year. And so many of our clients are actually going to undertake a pay equity analysis at the same time and fold those in at that point. So where do we go from here? Although most employers would fail the EEOC's EEO-1 pay equity review, there's going to be so many false positives on that. I'd really recommend that you are unlikely to undertake the kind of practice that you would need to do in order to have a truly kind of buttoned up employment system, which would be almost a unionized or government approach to pay, where, everyone after 6 months gets this, everyone comes in at the same salary, after 6 months you go up. Most employers are not interested or willing, or it doesn't even make any business sense to do that. It's largely unrealistic. So to begin to think about, actually, do you feel like your pay practices and policies, you can defend them? I wanted to just say that doing nothing really is no longer an option. Federal contractors are required to act. Private employers really are wise to start. I mentioned before, and I'll say it again, that I'd recommend not skipping the attorney-client privilege because, again, you don't want to be in a position where you've done this wonderful thing in order to kind of help your company mitigate risk, but unfortunately, because of a lawsuit, all of that gets disclosed. And often in a pay equity analysis, it can be a somewhat messy process. So, for example, you have privilege protocols. So, for example, you have identified an area where there is legal risk, but once you find out that IT example, once you look a little bit deeper, you find out actually those pay differences make a lot of sense. There's no reason to make an adjustment. And you don't want to have the drafts that you had where it said, oh, look, women are very underpaid in IT, be used against your organization when it doesn't make any sense to make any adjustments. So again, this feeds right into the next two, which is start with the end game in mind. Think of what your final objectives are. Do you have a budget to make any adjustments? When are you going to implement those, and make sure that the analysis follows in suit? The next one is don't stop after the preliminary analysis. So that IT example, exactly that. You don't want to just do the analysis and find that there are major differences in IT without actually doing a deeper review to see if there's something else that may explain those differences. Don't raise red flags when you make adjustments. Develop a strategy for communicating any changes and the timing of that. And we're finding a lot of our clients are being pressured by shareholder organizations or by even the employee resource groups within their organizations to make a public statement about pay equity. And my recommendation is that there's going to be a lot of opportunities to make those statements. And if you need to slow down and make sure that you feel very comfortable with the pay before you make a public pronouncement, I think that it's a good idea. Consider that you make sure that your HRIS systems have all of the documentation that you need in order to defend the pay decisions. Do you have a job evaluation system? Do you have a matrix? Do you have anything along those lines? Those are things to begin to kind of consider as you go forward. And then the last one is to develop for future checks and guardrails. So make sure that you're able to test your performance ratings, for example, before they come out. Look at proposed merit raises or bonuses before they become final. My thought is that if we all came back together, or if you were listening to a webinar like this 10 years from now, that you would find that in the same way that it used to be kind of very cutting edge to do an analysis of your performance ratings before they were rolled out, and now it becomes, pretty pro forma for most employers or for many employers. I think that the compensation is going to fall into the same process. So thank you so much for joining us today. I'm going to turn this over to Michelle, who's going to talk to us a little bit more. Thanks for having me.
Thanks, Christine. Great presentation, and I hope everyone got a lot of wonderful information from that and education. I know that we're at the top of the hour, so I'll be very brief, but I just wanted to, again, show you a little bit about what ePay does. We do offer a human capital management solution that really helps you manage HR and a lot of the HR and payroll issues and benefit issues that Christine was talking about. Helping you get through your EEO reporting and the new requirements that are coming, helping with your time and attendance type of analysis, your hourly analysis of employees, and what kind of jobs they're performing. Even performance management systems, so that you can really look at those performance reviews, start to monitor them, and look at your merit increases. So our integrated human capital management system is a seamless platform. It's a unified platform, and it takes you all the way from that applicant tracking on the very left side of the screen through human resources, managing your benefits, so benefits administration, time and labor management, payroll and tax, and performance management. And there's some neat features in the solution that allow your employees really to be able to be engaged with you and understand how they're getting paid. We have many mobile solutions and self-service solutions so that they can be immediately in touch on how they're being paid and the different types of information that you're tracking regarding benefits and demographics and things like that. We're also very proud of some of the reporting and the analytics tools that we give our clients so that you can really start to understand things, not only in the time and attendance side, but also the payroll side, so that you can start to make decisions. A lot of the things that Christine talked about today was you need to do an analysis, you need to get at your data, and that's what we try to do for our clients, is give them tools so they can get at their data. We also help our clients with payroll outsourcing, tax management, Affordable Care Act, and other types of services that are offered to our clients. We're just to wrap up then, I'm going to ask Christine if we could just get to the end of our slides, because we are at the top of the hour. And just want to let you know that at the end you'll be asked to complete a survey. And at the survey there's a few questions that you need to do, I think, for your credits. But also, if you would like to speak to an ePay representative, please give us a ring, let us know. And also you can indicate that on your survey, and we can also send you the slides for today. All right, we have an upcoming webinar. If we could go forward in the slides. We have an upcoming webinar coming up on August 24th. It is going to be demonstrating our solution, our human capital management solution, and really talk about the blue-collar workforce and what you need to think about before you buy. So please join us for that. Just go to our ePay website at epaysystems.com, and you can see all of our upcoming education, but we specifically welcome you to take a look at that, where we can share a little bit more information with you than we have time for today. So thanks again, Christine. Thanks everyone for joining. I will turn it back over to Kathy. At ePay, we would love to be your human capital management provider. We will hopefully talk to you very soon. Have a great rest of your day.
Great. Thank you, Michelle and Christine, for presenting this very informative webcast today. The archived webcast and slides will be available on the HR.com site within 24 hours. You will receive an email from HR.com with the certification credit information within 1 to 2 business days. ePaySystems and HR.com do appreciate your feedback, so please take a moment to complete the survey, which will appear on your screen at the very end. This concludes our webcast, and thank you again for joining us, and enjoy the rest of your day.